If you're trying to develop real estate without a pro forma, you're either going to lose a lot of money or your deal is going to fall apart before it even gets off the ground. A pro forma doesn't just tell you whether a deal makes sense, it's the key to raising capital, securing financing, and turning a concept into a real project. In today's video, we're doing something we don't normally do. We're walking you through a real-life pro forma, the financial model we use to underwrite our deals before we spend time and money on them. You'll see how the model is built, the assumptions that go into it, and why this tool is essential in every developer's toolkit. If you're new here, welcome. I'm Ben, a real estate developer with 30 years of experience. I started flipping houses in 1998. I learned every trade that I could and eventually transitioned into ground-up development. These days, I'm building mid-rise projects, and at the time of this video's release, we're developing a 70-unit building. This video is part 4 of a 5-part series on how to run a full feasibility study. If you want the full blueprint, make sure to check out the rest of the series. All the videos in the series are linked in the description below. And if you haven't started from the first video, I'd recommend you watch that now. Now let's jump into step 4, the pro forma. So tell us about the building characteristics.
This project is a property with about 22,500 square feet of land. And on that land, based on the zoning, we can build up to 6 stories, right? So, whenever we do this, we look at that lot, and one of the first steps is thinking about the physical characteristics of that building and what we can build on it, right? So as part of that site analysis that we do in the beginning, we start thinking about what's the building envelope, what's the massing, what are the setbacks from neighboring lot lines, how tall can you go, what can you fit in it, what's the density, how many units can you do, all that stuff that, we do our research as part of the site analysis. And on this project, we're able to build a 6-story building, and that has about 87,000 gross square feet. The net square feet is 65,000. And so the difference between the two is the gross includes everything, right? Hallways and common areas and stairwells and utility rooms, mechanical rooms, all the things that you can't necessarily rent to somebody. But it costs you money because you got to build it, right? So it takes up parts of that floor plate and part of the building. And when we do that analysis, there's a lot of assumptions that go into it, and these assumptions get refined as we're doing that site analysis. And so on this project, we have a 6-story building where the floor plate of that building is uniform. It's about 14,000 square feet, gross square feet per floor. There's a couple apartments on the first floor, and then all the apartments from the second floor to the 6th floor is about 17 units per floor. You add all this up, you get to about 65,000 square feet. So, when we're doing this analysis, we're trying to figure out the physical characteristics of the building.
So for those who don't know, where did you get these numbers from?
When we do this initially, we do a massing diagram, right, to get some high-level building envelope dimensions. That's kind of like the first step, and it's constantly getting refined, as we know. We'll take that initial massing that perhaps we do it with an architect, perhaps you and I, we do it together with some sketches on a piece of paper, and then we'll refine it as we go, because we start to look at it and say, okay, it looks like the floor plate's coming out to this size. How many units can we fit on that floor? Where do we fit the stairwells? Where do we fit the building core, elevators, all these different things, since this is a multi-unit building. So
we're talking about the schematic design.
Yeah, high-level schematic at that point. But then as we move forward through this process, this pro forma is like a living, breathing thing. It's constantly changing, constantly getting refined. So eventually we retain an architect. We start to get a certain level of precision and make it a lot more following the zoning as well as building code requirements that an architect and engineer has expertise in, right? And then as we continue to move along, as we're doing construction drawings, we're getting even more refined with these numbers because layouts change and you have things that come up like a shaft or whatever that goes through the entire building and affects layouts and how much net square feet you have, gross square feet you have. So these things are constantly getting refined, but as an initial step, we start with the massing, right? And as we're doing that, we're incorporating those physical dimensions and assumptions into this pro forma, so we can get to a point that we can understand, all those inputs, because they drive a lot of things in the model. So gross square foot is important because gross square foot costs money. So all that stuff that you got to build has an impact on the cost assumptions around your project. That initial step is just understanding the physical characteristics of the building, and then looking at those physical characteristics to determine, okay, how many units can we potentially fit in here? What are approximate unit sizes? And that starts to get into more of like a market analysis, right? Understanding, what is a typical studio that is acceptable in this market? What is demand saying about studios? What does a 1-bedroom look like? What does a 2-bedroom look like in terms of size? And figuring out, okay, based on what the market is telling me as to what our tenants want, how big those should be and how they might lay out on that floor plate, and trying to get to an overall unit count. And that's all that initial analysis that we're doing that becomes part of the assumptions in the pro forma.
So the pro forma is basically drawing off of the schematic design, the market study, and some site analysis that you did in the beginning.
That's right. So once you get that physical aspect, the massing information to understand what the building's starting to look like, usually the next step is understanding, okay, that building has a certain cost associated with it to build it like that. And so I start to look at cost assumptions around that. So the biggest cost in all these projects is the hard cost. So this is the cost of all the physical material and labor associated with building that building. It's all the subcontractors that you have to hire. It's the general contractor that you hire, and the fee that you have to pay to the general contractor. And there are, on this project, based on, a number of factors as to the type of building we would typically construct for a 6-story building. We were estimating around an $18 million budget for the hard cost in this one. And that's something similar to the massing and the design of the building. It's evolving, right? So as we go through the process of, an initial massing, and then hiring architects and engineers, and then talking to a general contractor and talking to a subcontractor, we're constantly refining that budget, that estimate. And that number it's very detailed. There's a lot of information behind it. There's all the different trades, right? Concrete, sidewalk, framing, steel, all of your exterior finishes. That number, it's like taking all the million different components of a building and figuring out how much all that stuff costs in the aggregate.
So when you're this early in the pro forma, where do you get that number from?
Part of it is us having experience, knowing that a building like this that kind of fits within a certain profile, right? So urban building, 6 stories. In this case, it's probably going to be 4 levels of wood framing over a concrete, 2 levels of concrete. It's a rental grade building, so the finishes in the building are going to be similar of other buildings in the area, as well as taking into account, the market study that we did, right? Understanding, all right, we're trying to target a certain type of renter. In this case, somebody that's looking not necessarily peak rents, because in this market, rents could be as high as, let's say, $5,000 for a 2-bedroom in this particular building. And when I show it to you later, a 2-bedroom might be like $3,500. So, to achieve that kind of rent, it's going to have a certain level of finish, right? And so those kind of finish assumptions and the structure of the building, the things related to the mechanical, electrical, plumbing, we know that they're going to have certain features as building. And so a building like that is going to trend towards a certain number. And since in this preliminary phase, based on our experience, we know that a building like this may cost around this time about $205 to $210 per gross square foot.
But where are you drawing that information from? Are you asking contractors? Are you asking the general contractor? Are you drawing from experience?
Part of it's experience. Part of it is having talked to subcontractors to understand some of those trades, and then also talking to general contractors. So even though it's very preliminary, a GC can give you a certain level of number that is within a margin of error, right, at this early phase. Obviously, once we get to a point where we have construction drawings where you've actually spent a good amount of money, you can take those drawings, ask the GC to go out and get bids. Get bids from multiple GCs, and then the GCs will get bids from multiple subcontractors to get to a more refined number.
So when you're asking them the question and you're saying, what does a building like this cost? What are they giving you? Are they giving you a price per square foot? Are they giving you
They can
a lump
actually,
sum?
when it's very preliminary, it's going to be a wide range on a dollar per square foot basis. But as we know, when we go through the process of moving forward with getting an approval from a zoning, that drawing will have certain level of detail. And that drawing, even though it's not, detailed construction drawings, it's enough detail that a GC could look at it and say, okay, if it fits within this profile, this parameters, you can probably expect a budget of this, this range, let's say.
And you're explaining to them the building characteristics.
Exactly.
So that they can determine if they need to build wood frame, steel, or full concrete structure.
Correct. They're giving us feedback and we're giving them feedback as well. We're telling them the same parameters. It's rental grade finish. Here's the type of, finishes we expect. The exterior, all the elements, we know through experience that if you go with a certain structural type, that we can save money, right? So concrete building is going to be more expensive than something with wood frame. So, but depends on what we're trying to build and the market that we're trying to meet in terms of our customers, right? Perhaps if you're doing a condo project, high-end finishes, you may go concrete with, luxury finishes. That'll be a completely different price point.
High-end appliances, nice lighting fixtures, tile, things like that.
The price point would be completely different. So on this project, we're doing something that is rental grade. So on top of hard costs, the other thing that we estimate are soft costs. So, what's in soft costs? You can almost call it everything that's not in hard costs that requires you to, the physical material and labor to construct the building. There's a number of administrative costs that we usually detail out. We have lots of consultants that are involved on these projects. So these are all of our architects, engineers doing construction drawings, doing geotechnical studies, traffic studies, planning consultants. You can have interior designers. There's just a lot of different consultants that can help you along the way. The bigger the project, the more you tend to spend on those things. It includes all of our insurance costs, builder's risk insurance, or maybe liability insurance, owner's interest insurance. There's just a lot of things that you need to have in place in order to make sure you can build a building from the insurance side. The lender is going to require it. And obviously, as an owner, we want to protect our liability, protect the investment. There's things around, lots of attorneys are involved, right? So you could be spending well over $100,000 just on legal bills on a project of this size. Then we have things like marketing, kind of broker fees, model studio apartments, doing staging, all the advertising we might do, promotions, signage, videos, all the stuff that you tend to handle. All cities that you operate in, right? You have a permitting process. So there's costs associated with permitting. And then there could be a lot of government fees that you end up paying. There may be like developer impact fees and utility connection fees, things that sometimes rules change and new things come up, right? We have a project where we are having to pay a development impact fee. And then we always include in our projects a project management fee or a developer fee. And as a developer, when you're building something, we have overhead, we have people that work for us that are managing the project, right? And that are working on it. That overhead plus additional management is a management fee that we will make sure to include in our soft cost budgets on all our projects. Because there is a lot, as an owner of a building, there's a lot of work that's involved on behalf of the developer. This could be a year of process, right? Doing entitlements and zoning, and then maybe another year and a half to 2 years of construction period, another 4 to 5 months of lease up period. All that time is work that the owner and the developer is doing to manage that project. Then there's all kinds of other stuff, right? Surveyors, which are an important part of your overall design. Of course, there's a lot of holding costs, right? Depending on where you are, size of the project, we may have property taxes to pay. Certain cases, in this project, we have tenant buyouts, let's say. There may have been an existing building where you have to buy out tenants to kind of get them out. It just depends on the specific circumstances of the project. But on this project, it was, soft costs ended up being over $3 million, $3.5 million.
So soft costs are essentially the things that are going on behind the scenes, right? Things that you don't see on the construction site.
Right. And it's things that the developer is managing, right? So the GC is not doing this. The architects and engineers, that's the owner retaining those consultants and managing those people. In the marketing period, right? It's a rental building, so there's a lease up period. All that marketing and making sure you lease up the building quickly, that's not a general contractor. It has nothing to do with physically building that building. That's the owner figuring out the strategy and making sure and executing that plan. And then the other thing that I like to look at that some people call soft cost, but it is a soft cost, but I like to look at it differently. It's I call it financing costs. In this project, it's a little over $2 million. That's everything related to the debt, right? So this project's going to have a construction loan on it. And in this project, it's a $20 million construction loan. I'll get into how we size that. But all the costs associated with the financing. So that's the biggest being the interest. So during that period of time where you're drawing on the construction loan, you're paying interest. Maybe a broker fee, in this project, estimated at like about 1.7, 1.8 million of interest on the loan. There may be certain closing costs. So you're paying for the lender's fees, all the appraisal costs, the lender's attorney, which is usually a big one on projects of this size. Depending on the market, you may have a mortgage broker shopping around the mortgage. So you may pay potentially up to a point to originate that loan. All that is stuff that we include in our financing costs. And it can get pretty complicated trying to understand how much is construction loan interest. In this model, there's a whole projection that I do where we take that construction loan, we look at the hard costs, we look at how we're drawing on that construction loan and figuring out like, okay, this is a $18 million of hard costs, and we're going to end up drawing on this construction loan over that period of time during the construction phase. How do we draw it, and how much interest are we paying it? And so in this model, it goes through a process of projecting that. All that kind of builds up into that overall financing cost. So, in this project, you just look at these two numbers together, you're already at $5.5 million of soft end financing related costs. So it adds up.
It's amazing how the finance cost adds up to $2 million on a project like this.
Yeah.
It's a big number.
And that's just the construction loan. And obviously that, financing cost ebbs and flows, right? So in a market where interest rates are higher, that financing cost is going to be higher. So,
and that's if everything's on time, right? If you go over time, then you're going to add some more. So do you build in any contingency on the financing cost?
So usually what I'll do is, because this is projected pretty precisely, there's an assumption in this pro forma around time. So how long is it going to take us to build? How long is it going to take us to lease up? From when we close on the land to when we close on the loan, all of that is projected. And one of the things that I do in here is sensitize all that. Oh, what happens if the construction time doesn't take 20 months? It takes 24 months. There's a whole sensitivity that we do that I'll show you later that kind of goes through that and sees what's the impact on the profitability of the project. But yeah, things like hard costs, soft costs, there are built-in contingencies. So like hard costs, anywhere from 5 to 10%, soft costs anywhere from 3 to 6%, let's say. And since soft costs is something that we can control, we can kind of, except for holding costs, because we can control it, we can kind of project it a little bit better. And then other things, obviously, in this project, we acquired the land at about $4.65 million, which values at about $50,000 a unit, or $50 to $70, $50 per gross square foot, around $70 per net square foot. And in this particular case, because we are always trying to acquire land off market, right, create value through the entitlement development process, if we do our job right, that land's would be worth more than what we paid for it if we do it right. In this project, we assume that the land's worth about $6.5 million after we're done with entitlements and approvals. And then we can borrow against that as part of our construction financing. And these are all assumptions that are related to the construction loan. Then there are other like little costs like lease up shortfall that I like looked at separately. This is just, when a building is finished, there's a period of time where you start incurring operating expenses, but the building's not leased up. You're paying property tax, you're paying for utility bills and insurance and things that are just part of the overall operating expense of the building, but your revenue is zero and you're ramping that up to a fully leased building. And so you got to make sure you cover that shortfall. So when you add up all these numbers on this project, you're getting to close to $28 million, including additional working capital. So the next step is figuring out, okay, this project costs this much. How do we finance it? Right. So we already know we're going to have a construction loan. And then we're going to need some equity to fund that gap.
Before you get into that,
Yeah.
what is acquisition cost?
One of the things I like to look at separately from other soft costs is when we purchase the land, sometimes the number can be higher depending on the circumstances of the project. On this one, it's everything related to that initial acquisition of the land. So it's like title insurance, maybe some small legal fees related to the purchase contract. It's just stuff related to the closing of the land.
Any reason why you don't take that number and put it into the soft cost?
I like to look at it separately because of when that cost gets incurred. And it tends to get incurred at the closing date of that land purchase. And so it's part of my, it's a very detailed projection in the pro forma where I look at, like in here, I have a projected forecast of when these things occur. So this is like, time year 0, year 1, year 2. There's a whole projection of when these costs are occurring. And because of that, I like to think of acquisition costs a little bit differently. Some projects, that number can be higher. There can be things in it that are not in this particular project, but maybe like additional environmental due diligence costs and things like that occur as part of the acquisition. Like I was saying earlier, the total costs, the uses of cash, all the costs of that project to get to a completed state. Then we got to figure out, okay, how are we going to finance this thing? So in this case, we're always going to, not always, but in this particular case, we will typically finance it with a construction loan. And here we financed it with about $20 million of construction financing, and then which leaves a gap of about $8.5 million of equity that's needed. In this project, we did part of it as preferred equity, part of it as common equity. I'll get into that in a sec. But with the construction loan, we size it to $20 million, and depending on your lender, the lender wants to make sure that if they're going to give us $20 million to fund this thing, that when the building is finished, that construction loan can be taken out, right? So on this project, we go through a process of projecting that. Which I'll go through in a second. But on this project, it does. There's enough revenue being generated by this building that when we're finished, we can borrow, let's say, a 5-year mortgage, 5, 7, 10-year mortgage at that point in time when the building's finished to pay off that construction loan in full. And then, in this case, it's about 70% loan to cost, which is reasonable depending on the lender. Some lenders might be more conservative at 65. Other lenders might be more aggressive at 75. But 70 is a good target. And then even when I look at it on a value basis, it's even less. That 20 million might be closer to about 57% of this project, factoring in the value of that land, the value that we created through the entitlement process. Then in terms of equity, like I was saying, it's about $8.5 million. And here structured it as part preferred equity and part common equity.
So what's the difference between the two, between preferred equity and common equity?
So on this project, the preferred equity is getting 12%, and that preferred equity does not participate in any upside. So it isn't sharing in the profits. It's just going to get a fixed 12% return on the money that's invested on that $2.5 million. But the benefit you get is that you are senior. So meaning that common equity sits subordinate. And before the common equity, which is the owner and the developer, gets any money, the preferred equity has to be paid off first. And so when I show you the projection, of the building and what's happening when the building's finished.
But the preferred equity gets paid off after the construction loan gets paid off, right?
Yeah, so the waterfall here on this project, when the building's finished, we're estimating a permanent loan of about 26.3 million. On this project, there's a mortgage that we get when the building's finished of about 26.3 million. And the way that loan was sized is there are certain assumptions around that. And in this case, it looks at how much revenue is the building generating, and based on that revenue and what the building is worth, how much permanent financing can we get at completion? And the assumptions around that, there are usually a couple of things that affect how much money we can borrow at the end. Things like loan to value, obviously the interest rate on the loan, these things called debt service coverage ratios, based on the cash flow you're getting from the building. The lender obviously wants to make sure that there's enough cushion between how much cash flow the building generates and how much money you have to pay to the lender on a monthly basis. What's the amortization period of that loan? So in this project, we assumed 30 years. So that over a 30-year period, if you were to keep that loan in place, the 26 million will go down to zero. You pay it off in full in 30 years. And a 1.25 times debt service coverage ratio. So with all these assumptions, we're able to borrow about 26.3 million. And then when the building's finished, going back to the waterfall, that mortgage, that refinancing event will allow us to generate enough proceeds to do something with it, right? So we'll pay off the construction loan first, because that's the senior most part of the capital and the overall capital of the project. There may be some origination costs with that permanent loan. Once you do that, on this project, there's about 6.2 million of proceeds left. So
what's the $300,000 there on that line item?
So usually when we're running our numbers and we're raising equity, that 8.5 million of equity that we raised, some of that goes towards just working capital, right? So these are all the costs of the building, that 28.5 million of approximate costs. We raise a little bit more than that because at the end of the day, you can't draw down your bank balance to zero. You got to make sure you have enough capital to just cover the ebbs and flows of the project, and making sure there's enough cash in the bank account to constantly fund the costs. Now, you don't necessarily spend that money because there are contingencies in these cost estimates already as well, but it's just working capital that's there available. So when the project's done, if everything goes according to this pro forma, that capital is just sitting there in the bank account. You can release it back to the investors. So it just goes into the overall pot of money that's available to distribute and give back, because you don't necessarily need to maintain that size of working capital reserve once the building is finished. So in this case, the first highest priority equity capital, is that preferred equity. So here, there's about 740,000 of preferred interest that's accrued from when that 2.5 million is invested to when that refi event occurs. And there's a projection in this model that goes through that. You pay that back first, and then you pay back the actual capital that was invested. So the priority goes, you pay back the interest first, and you return all the capital next on the preferred equity. Here, there's plenty of proceeds available to do that, right? So you pay back all the preferred equity, there's another 3 million that's left. Then you can pay back the common equity that's in this capitalization. So here, there's about 5.9 or 6 million of common equity, and that common equity, it's subordinate to the preferred, right? So there's higher risk with that. But it's the owner along with the developer. So it's sharing in the upside. So it shares in that profit, may have a longer time horizon. So this building, perhaps once it's finished, we own it for another 5 years, or we own it indefinitely. But that common equity is the one that's owning that building along with us as a developer. And here, before the developer got money and participates in that profit, we had to pay back the common equity first. And at the refi, there's at least enough proceeds to return capital. And here, there's an assumption around let's say a 7% hurdle rate. So depending on the project, depending on how we decide to finance it, here we may have a concept of a hurdle rate, and you'll see a little bit later how that kind of comes into play in a sales scenario when there's plenty of proceeds to distribute to everybody. But at the refi, there's at least some amount of capital that goes back to the common equity investor. In some projects, you could potentially return all the capital back, which is, great, but it just depends on market conditions at that time. And then the other thing we like to look at in terms of...
Just back up a second.
Yep.
Set up. What does that mean at the bottom, where it says net equity return of capital?
This line right here?
Yeah, where it says net equity remaining at refi. What does that mean?
So one of the things I like to look at is once you pay back this capital to the common equity, how much money is left over that they have invested. So at the refi, we're giving back about half of the money. So here it's $2.9 million of proceeds available. It equates to about half of the money that was invested of that 5.9. So what's left over? It's another $3 million that's still in the deal that they've invested. This is actually in a refi case. This is a win.
So that's what's left in the deal based on the valuation of the building?
No, in terms of cash.
In terms
not
of cash.
valuation.
Okay.
In terms of valuation, that'll be a different
Where's
setup.
that cash?
And so you return $3 million. It's just sitting still invested in the project. So that $3 million's been invested. It's still waiting to be paid back, either through cash flow going forward or when you sell the building, let's say. And so like the rest of the distribution starts to make more sense when you look at a sales scenario. And that's where you start to get an idea of, okay, we finished this building. If we hypothetically sold the building when we finished it, did we generate a profit? How much money is returned to everybody? How much profit is returned to the common equity investor, the preferred equity guys, the developer? And that's looking at a different scenario. So this is a scenario where we're looking at, what does the sale look like when the building is finished? And so the way that waterfall looks is you have to first value the building, right? So in this project, we get to about a $40.8 million valuation. And the way we get to that is we do a projection of the building and what NOI or net operating income is being generated when the building is finished.
What's NOI?
So on this project, we get to 2.2 million of NOI, net operating income, when the building is finished. And the way we got to that is, and we haven't covered this yet, right? Looking at all of the revenue that's being generated by the building. So in this case, it's rent. Maybe there's parking, maybe there's some parking income. There may be some other ancillary income like amenity fees or whatever the owner is charging to its tenants. The total revenue of the building minus the recurring operating expenses. So this is things like property taxes, insurance, there may be payroll or super, it'll depend on the building. There's obviously recurring maintenance contracts you have with like HVAC or your elevator. There may be certain recurring repairs and things that tend to occur. It generally doesn't include large one-time CapEx, let's say, capital expenditures, but maybe some reserves that we keep on the side for capital expenditures.
And it doesn't include mortgage payments.
It does not include mortgage payments, correct. Yeah, so it's just purely looking at the operating expenses of the building. It doesn't include things like capital cost. So the cost of the preferred equity, the cost of the debt, that permanent mortgage that's in place. So on this project, we obviously did a market study right in the beginning. We tried to figure out, what does a studio, 1-bedroom, 2-bedroom look like? What is the revenue? What are the rents for those types of units? And so in this building, when we did the analysis, we saw that in this market, for a typical studio, we could charge about $2,500. Typical 1-bedroom, maybe around $2,900. Typical 2-bedroom, around $3,600. So, that massing, that initial physical setup that we did, we were able to figure out that we can get to 93 units with a mix of studios, 1-bedrooms, and 2-bedrooms with 2 bathrooms. We were able to achieve that type of setup in this building. And the rents that we could charge using the market research that we did got us to these figures. which gets us to total revenue of about 3.1 million, factoring in other things like parking and other income and a general vacancy on that stuff, because all buildings will have some level of vacancy because there will be turnover and downtime and things that occur naturally in the building. And in this market, a good assumption would have been 5%. I think right now, actually, buildings are sub 5%, maybe like 2.5%, because the market's really tight in our area right now. But the market research will tell you kind of where that sits for the area, and 5% is a good assumption on this building in this market. And then we have our expenses that we projected here. For this building and the type of setup, 93 unit building, there are things like a payroll or super, just common area maintenance, unit maintenance. We know we're going to have certain turnover costs that occur whenever the building turns over. There's certain capital reserves that we like to do. Obviously, elevator maintenance, marketing. Depending on your leasing program, you may have to pay lease commissions. Depends on the market. Then there's obviously property taxes, insurance, all your utilities, and then a property management fee. So a building like this, we as a developer are not going to manage the day-to-day. We will include here a 3% property management fee that we will pay to a third-party property manager to deal with revenue collection, general maintenance, work orders, paying all of the bills and managing all the contracts that are related to maintenance. And a pretty good assumption around that for this market is about 3% for the type of revenue this building is generating. And so that comes to about 930,000. So that's how we came, that effective gross revenue minus those expenses came out to about 2.2 million of net operating income. Does not include the debt service, the cost to pay the mortgage on the building. So with that kind of NOI, we're able to determine what is the building worth when the building is finished. And in this market, part of the market research that we do, that market study, not only are we trying to figure out how much rent can we charge, what kind of units do people want, what kind of amenities are in the building, what type of features are in the apartment, like do we have washers and dryer. Not only are we doing that research, but we're also doing, what are buildings worth in this market. Right, we're trying to understand what's the cap rate, which is one valuation metric. How much are buildings selling for on a dollar per square foot basis? What are they selling for on a dollar per unit basis? So these different valuation metrics help us understand what this building is worth at the end.
How does the cap rate work when you're calculating the value?
It's a very simplistic formula. So it's just taking the NOI of the building divided by the cap rate gets you to the value. So here it's 2.2 million divided by a 5.5% cap rate, getting to a $40.8 million value. So it's a relationship that helps us understand that the income of this building, how does it relate to the potential value of this building? So it's kind of like a yield concept. This building is yielding a 5.5% yield, NOI yield on a $40.8 million valuation. And then other metrics like, okay, what does that mean in terms of per unit? 430,000 per unit. What does it mean? Dollar per square foot, 465 in this particular case. So these are all metrics that we look at to try to understand if this number makes sense.
What happens when the cap rate goes down?
So if the cap rate goes down, that's a good thing. Thumbs up, right? So in this case, the value of the building will go up because the market is saying that it's willing to accept a lower yield for whatever reasons. Maybe interest rates are lower, people's appetite for yield is higher, so they just if there's a period of time where you have low interest rates, there's not really other options. People are maybe willing to accept a lower yield and thus pay more for the building.
So the cap rate fluctuates based on interest rates?
It definitely does because it is a yield concept. It may not be linear, but it definitely has a relationship because, investors, people that buy buildings like this are usually investors. So there's a universe of investments, right? So you could invest in the stock market, you could invest in the bond market, you can invest in private equity businesses, you can invest in real estate. So, real estate as an investment class will fluctuate relative to those alternative options. And so Cap rate is one of those measures that helps us understand, okay, this building yields something, and that yield, in this case, let's say 5.5%, is that a good enough yield relative to other things that I can invest in? And so if I can go out and buy a treasury bond at like 6% and do nothing and have no risk, and let's say that's like a 10-year treasury, an investor might look at that and say, oh, why would I buy this for 5.5%?
Right. So I see that button there, that the number 5.5 is green. Can you change that? Like what happens if you go down to 5%?
So 5%, it increased to 44 million. So another $4 million of value.
So just that half a point, you got another $4 million.
Yeah. And obviously on the downside case, if you went from back to 5.5 to 6%, it dropped by about 4 million. Not necessarily, really more like 3.5, but yeah, that's a key number. So it's one of the things that we sensitize. So it's like, oh, what happens if values of buildings go down, right? Thinking about a downside case. As you can see, there's lots of assumptions in these pro formas, and I'll show a little later how we sensitize those things to help us understand what's the risk in this deal. So going back to that waterfall, assume you sell the building when it's done. At that $40.8 million valuation, there may be some costs associated with selling the building. You pay off your construction loan. Similar waterfall as before in the refi event. Pay off the construction loan first. There may be some reserves available that you release. Here, there's plenty of net proceeds available to pay back that 12% return of the preferred equity, return all the preferred equity capital back, the $2.5 million. In this particular capital structure, we assumed a 7% hurdle rate for that common equity, which here amounts to about $1 million. We returned all the common equity, $5.9 million, return all that common equity. Then there's money available to distribute even further, right? When we sell the building, we have something here called a catch-up distribution to a developer. So this waterfall has to do with capitalization, and there are many, many different ways you can structure this. On this project, we have something where if we generated enough return to the investor, we met that 7% hurdle rate, so the developer gets a match. Because on this project, it's a 50-50 deal where we want to make sure that we get 50% of those profits. And so in order to do that, we have this catch up where that $1 million we gave to the common equity, we matched it here to the developer. Now we're splitting things 50-50 between our common equity investor and the developer. When you look at that and you start to think about, okay, well, what did our investors get? They invested $5.9 million. They got back over the life over that time period from when you started the project, from when they invested to when you sold the building, when it's completed, of about $11 million. So they almost doubled their money. There's about $5.1 million of profit on this. So different measures that we like to look at are return on investment or equity multiple. These are very similar in concept, but just two different ways to look at it. Equity multiple says that this 1.86 number says that for every dollar the investor puts in, he's getting back 1.86 times his money. So $1.86. So if you put in 100,000, you got back 186,000.
So that 86.4% ROI, in what period of time was that made?
So in here, this is probably around 2.5 to 3 years, let's say, from start of the development process to acquisition of land, to entitlements, to starting construction, finishing construction, stabilizing building. So
it's about,
could be about 3 years.
It's almost like 27% per year.
Quick count, yeah. Yeah, good math. 28.
I was off by one.
So that's looking at it on an annualized basis, right? So, and this is assuming that we sold the building, and you don't necessarily always do that. There may be a situation where we decide we want to keep the building and look at it as like, get some of the tax benefits and hold on to the building for maybe another 5 years, get cash flow. And this model actually goes through the process of looking at that, projects out the cash flows, and I'll go over that. If we do our job right, buy the land at the right price, manage the cost efficiently, get the right approval, make sure we build something that the market wants and that the tenants want, and we lease it up, we should have created profit, plenty of profit at completion.
So what do you look at when you're determining if this is a good deal? What are the key numbers here? Is it the ROI? Is it the debt service coverage ratio?
I call this sort of like a snapshot view, where it's not looking at what happens post completion after we're finished the building, hold on to it. Here, these metrics around equity multiple ROI are key numbers that I would look at, because at the end of the day, we want to make sure that the investors have made money, because they're taking risks along with us as the developer, and that we as a developer are making enough money that we're incentivized. Because when we do these projects, we're giving a personal guarantee on a $20 million loan, right? And so we need to make sure that these risks that we're taking, that everybody's getting compensated enough to do it. So, a deal like this where we have common equity investors, right, that are the most subordinate capital, we want to make sure they're getting at least a annualized return that is in the upper teens. So like, let's say 18%, 20, here on a 3-year time frame, it was around 27, which is very high. We want to make sure that they get enough of an annualized return that for the risks that are taken, this being a development, ground up new construction, high risk, opportunistic type investment, that we're getting to a return that's at least in the upper teens. And then obviously we as a developer want to make sure that we're getting compensated for finding the deal, structuring, putting it all together the business plan, running that project, getting it to the end, and paying the investors, and also creating enough value that the developers getting that promote, right? That 50% split. And obviously, we've seen deals from what other people have paid. Not all projects make money, right? So finding deals like this takes time and effort, right? So it's not always a slam dunk, but this project is a good one. And I'll show in a little bit when we project the future, what does that mean in terms of return for the investors and for the developer? So that's kind of looking at it on a snapshot basis. So the other thing that we do is, this pro forma is pretty detailed. It's looking at, what does this building do after it's finished? It looks at it on a monthly basis, but it's easier to understand and digest on an annual basis. It will project that net operating income over time. So, year 0 start, and let's say over a 7-year time frame, we finished it in year 3, and we, let's say, hold it for another 5 years. What does the NOI do? How does the rent grow? So there are assumptions in here around how the rent is growing. Here it's a very modest 3%. That's a pretty standard assumption, very reasonable. Obviously, if that growth rate is higher, the returns that number can have a huge impact on the returns, growth rates. We also should always assume that your expenses are going to go up too. So, our expense goes up over that time frame as well, and the NOI grows. And as the NOI is growing, that means the value of that building is growing, right? So in that cap rate calculation, there are a couple of levers, right? There's NOI, there's cap rate, and there's the value. So if cap rate stays the same, but NOI is growing, that means the value will grow as well. So that's one of the levers you can pull. If we manage the building well, manage the expenses well, the market, there are certain factors on the revenue side we can't control, right? But if we manage the building well, we build a good product, one that has good demand from our tenants, they like living here, they like what we offer, then we should be able to grow our rents on a reasonable basis as well. So that this pro forma will project that, how that NOI grows. And then the other thing that we always look at too, right, is, like you asked before, net operating income doesn't factor debt service. It doesn't factor in how much are we paying on that mortgage. So the other thing that's important is looking at, okay, at that $26 million permanent mortgage, how much is the debt service? Going back to those assumptions on the refinance, that $26 million that we borrowed when the building is finished, at a 5.5% interest rate, you're looking at about $150,000 monthly payment to the lender. And so that is what I would call below NOI. It's not part of NOI. So when the building is finished, that NOI that's being generated, you'll be paying almost $1.8 million total annual debt service, and you're left with about $450,000 of cash flow after that NOI. And so that cash flow is available, goes into the overall pot to pay distributions. And on this project, we have some other things that we add on top of that, right? So there's an asset management fee. So when the building's finished, the job's not done, right? So somebody has to not be the property manager, but manage this building from the perspective of an owner. So dealing with the lender, making sure whatever the lender needs is handled, making decisions around leasing, right? So the property manager may be handling leasing, but their job is not necessarily to set the rent and make sure you're maximizing the value of that asset. So somebody's got to manage that property manager too.
Somebody has to be responsible.
Somebody's got to be responsible, right, for that property manager. Like his incentive isn't necessarily to keep the operating expenses low. They're not an owner. They're just getting a fee for their work. The asset manager's got to make sure, the owner's got to make sure, in this case, the developer is making sure that that property manager is doing their job right. Keep those expenses low, manage the building well, keep all the tenants happy. It's like another layer of escalation. And so for that work, the developer or the owner is getting a management fee. And then there are other things that can be included in the waterfall. There's a concept of a current promote that I've put in here as an incentive to the developer owner to maximize the cash flows. The developer gets to participate in that cash flow by taking here 5% of the cash flow, of the after debt cash flow. And then whatever's left over is what gets distributed here. It's about $393,000. And that's all forecasted in here. There's a whole forecast of all these cash flows coming from the building. And depending on what ultimately ends up in the pocket of the investor depends on how the project is performing. And so here, there's a projection around that common equity, the investor. How much are they getting over the time frame? And here, you can see that the cash flow grows over time. And so we like to look at that and see, okay, what does that mean in terms of returns? What does that mean in terms of metrics like cash on cash? Taking that cash flow, dividing it by, you remember that number, that $3 million number I said, like how much cash is left over from the investors? You could look at that number and say, okay, the investors are getting anywhere from $430,000 a year. 430,000 divided by 3 million. It's a good number. It's a very high cash on cash.
That's us chipping away at that 3 million.
Correct. It's returning that
every
capital
year
to the investor every year. But from the perspective of the investor, it's like cash flow in their pocket relative to the 3 million they have left invested. It's a good return. It's in excess of 10% of cash flow per year.
All while still having equity
All
in the
while
deal.
still owning that deal.
Right.
They're still in the deal. And so that waterfall, right? We have something in this Pro Forma, I have something called an equity schedule. It's complicated, but it applies the waterfall, all that promote, the hurdle rate, the developer match, all that stuff. You put all of those through the waterfall. And in the end, you look at, okay, what does that mean to the investor? When the waterfall is applied over time, this is like what I look at as like the end result. Factor in everything, all those cash flows, all the upfront investment for the land purchase, the money you borrowed for the construction loan, all the hard costs, all the soft costs, all the cash flow you get from the building when the building's complete, the money that comes in at the refi, and then eventually selling the building. Let's say in this particular case, there's a 7-year projection. So you sell the building in year 7, you put all that money through the waterfall. What does it mean for everybody that's involved in this project on the capital side? So like I said, originally, here is the preferred equity investor. Money comes in at the beginning, and in year 3 at the refi, they get back their preferred return, they get their money back. They're out, they're done. You can see it's all zeros. They're not in the deal anymore. They're out. The common equity investor stays in the deal. So they invest in the beginning. There's no cash flows from them after that during that initial period because the building's under construction. And eventually the building's done. There's a refi event. That money comes through the waterfall. So in that year 3, when the building's finished, money starts to come back to that investor. Money starts to go to the developer as well. And then over the period of time where we own the building, that 5-year period in this case, money's going to the investor and money's going to the developer. And then eventually in year 7, you sell the building and you look at what does that mean? So when you factor in all those cash flows, one of the things you calculate is IRR, so which stands for internal rate of return. And here it's about 20%. And so like I was saying earlier, right, like a deal like this, opportunistic, a 20% return is good. And then the other metric you like to look at is equity multiple. So it's looking at, it's a slightly different way to think about IRR. It's thinking about it on an absolute basis. So here, for every 2.62 times, it just means that for every dollar that I as an investor put into this deal over a 7-year time frame, I will end up with $2.62 back in my pocket over that 7 years. And on an annualized basis, that means I'm earning a 20% return on every dollar of investment. That's a good deal for something like this.
It's a very good deal.
The other thing to keep in mind is that return is after the 50%, right? So the developer, in this particular case, it was a 50-50 split. Sometimes maybe it's a 70-30, let's say, or a 60-40. Just depends on the circumstances of the deal and what's possible. That means the underlying property, the underlying cash flows of the property in this particular case, this building actually generates almost a 30% return, this investment. And so what's happening is we're slicing up that return. We're saying, okay, some of it goes to the developer and some of it goes to the common equity.
And some of it goes to the preferred equity.
And some of it goes to preferred equity. So we are slicing up that return in different ways to make sure everybody who's participated in that risk is being compensated accordingly for taking that risk. And here, one of the things I like to see is that kind of cushion makes me feel really comfortable knowing that if something bad happens, right? If the underlying real estate, cap rates, market rent growth assumptions, valuations, costs, all these different things, if they go against us, that return, there's ample enough return in this deal that it can withstand that shock. There's still enough return in the deal to make sure that everybody gets compensated for the risk. So one of the things that we do is like what I mentioned before, a sensitivity analysis. So there's like a whole projection in here that looks at, what happens if my hard cost goes up or goes down in a good case? What happens if the interest rate on the construction loan goes up or down? What are the impacts to the returns for the investor? Here, everything's positive. There's no losses. There's so many assumptions in here that could be flexed, right? Like what happens if, things that we've been worried about lately, right? Like interest rate in the construction loan. What happens if something crazy happens? You're like paying 12%. What happens to the preferred equity? What happens to the common equity? No losses.
No losses if the rate goes down by 12%. I mean, if the rate goes up
to 12%,
12%
on the construction loan,
there's no loss.
So
is that what you're saying?
Yeah. And then there are things like, other key numbers, right? We were talking about before. What happens if things that we've been worried about are like, what happens if that interest rate on the permanent mortgage, right, at the refi when the building's complete is higher than we expect? What does it mean in terms of, the amount of proceeds that are available when the building is complete? Here, it's quite safe. There's always enough proceeds to pay off the construction loan, even at 6.5%. It's really not until you get to like, let's say 7%, where you have cost overruns and budget, like crazy things happening that you start to see things. But the point of all this is, at the end of the day, you want to sensitize all this because there are assumptions and things can change. You want to make sure that the returns and the things that can occur along the way, that the project can withstand those shocks. And these are all things that, at least in Excel, you can do very quickly and calculate pretty nicely.
But a lot of people don't.
Yeah, I tend not to see it. At least they might do it. They don't show it, maybe because there's something bad.
Well, they try
hiding in the background.
I think they try to stay optimistic so that, they want to do the deal, right? And they want to convince the investors. But the reality,
themselves or
The reality is you want to make sure that the deal makes sense. You don't lose your money and the investor's money.
Yeah, I feel like that's like sacrosanct, right? You don't want to get into something where you make a promise that you can't meet. All of that put together, that returns analysis, I'd say is like that final step to make sure, and that sensitivity is to make sure that it encapsulates everything that this project involves. Everything from like that initial site analysis and the physical stuff and the setup of it to all the costs associated with building it, how we're financing it, all the assumptions around our projections and the market analysis that we did, what kind of rents we can achieve, what they think the building is worth. It's like that end number that kind of tells me, okay, is this project a good investment for us as a developer and the risks that we're taking, and for the investors that in the end we're going to have to raise capital to make sure that they are being compensated for the risks they're taking. Every project that we do, right, we do detailed analysis like this. And this pro forma, as you can see, has lots of assumptions in it. So it's like a living, breathing thing. It's constantly being refined as we work on this project because we're through the process getting inputs and updated and more precise information, which is why when we do that first step, that first analysis where there are a lot of unknowns, we're always making sure there's lots of room for error, a big margin of safety, right? We're negotiating an acquisition on a land purchase. We're making sure there's enough room for error. But with enough, I think with the experience that we have, we're able to get a little bit more precise on these assumptions as we go along. And we know certain things from the beginning, how this is going to play out.
And this thing is living and breathing till the very end, right? So as we're building it, as we get to the end and we're renting it out and new numbers are coming in, you're plugging in these numbers to see if this thing is still working till the very end.
And that sensitivity analysis is before we know all that stuff, right? The actual results start to come in, is making sure that whatever that number ends up being, that we're protected, that it's going to work out. But as we go along, we're still plugging those in to make sure, the rents came out higher. This is great. Look at what it means for our returns.
So not only do you use the pro forma to project, but you also use it to monitor what's happening in real time.
Yeah, we're always going, during the course of the project, we're always going back to look at this and say, how are the actual results comparing to these projections and budgets, and seeing what it means for everybody. So I think any good developer owner should be doing that to make sure that the investment makes sense and it's still making sense.
Every real estate project starts with an idea, but it only becomes real when the numbers work. This is the power of the pro forma. It pulls together everything from your site analysis and the schematic design to your cost estimates and the market data. And it helps you make smart, confident decisions. If you're trying to develop real estate without this level of financial analysis, you're heading for trouble. So study the process, build your own model, and don't spend a dollar until the numbers make sense. Now it's time to move on to the fifth and final step, the investment deck. In that video, I'll show you how to take your own pro forma and turn it into a compelling investment deck. One that gets attention, builds trust, and raises capital. Just click right here on the screen to keep watching. If you happen to miss the other videos in the series, click here to start with the first video in the feasibility series, where we break down how to evaluate the development site and figure out if it's even worth pursuing. And if you found this helpful, don't forget to like the video, subscribe to the channel, and turn on notifications so you don't miss future videos. I'll see you in the next one.